Baxter International and Abbott Laboratories. And this is who our group consisted of: Tony, Matt, Emily, Jen, and Gaia. And Gaia will start us off with the history.
Okay.
I don't think so.
Abbott is an American-based global diversified pharmaceutical and healthcare product company, and it has 9,000 employees in 130 countries. It was founded by Chicago physician Dr. Wallace Calvin Abbott in 1888 in his apartment, actually. And in 1900, the business officially incorporated in Illinois. And beginning from 1910, the company expands its branches like New York, San Francisco, Seattle, Toronto, London, and India. And in 1931, Abbott's first international affiliate is established in Canada. It became international. And in 1959, Abbott's corporate brand symbol A was introduced. And with 1962, they entered the Japanese market. 1985, Abbott launched the world's first HIV antibody assay. Between 2001 and 2010, Abbott acquires new businesses such as BASF, Vices Incorporation, Widums Incorporation, Cos Pharmaceuticals, Ives Biosciences, Visiogen Incorporation, Evolve Incorporation, Solvay Group, which are generally in biotech, molecular diagnostics, vascular products, diagnostic testing, cataract technology businesses. And Baxter is one of the main competitors of Abbott, and this is Baxter is an American healthcare company which headquarters is in Deerfield, Illinois now, and the company focuses on products to treat hemophilia, kidney disease, immune disorders, and other chronic and acute medical conditions. The company was founded in 1931 and opened its first manufacturing facility in Billings, Illinois in 1933. And in 1945, Baxter established one of the most outstanding growth records in American industry. In 1947, the company moved from its Glenview facility to a larger plant, headquarters, which was in Morton Grove, Illinois. In 1954, the company opened first international office in Belgium. 1961, Baxter stock began trading on New York Stock Exchange, and then Baxter joined Fortune magazine's listing of the 500 largest American corporations in 1970. And in 1996, Baxter opened 2 more plants in China. So, and between 1997 and today, like Abbott, they acquired lots of companies such as Immune International AG, Omedas Pharmaceutical Products Division, and Baxter Corporation, which are generally in the business of infectious disease research or automated compounding systems. That's all for history.
Okay, for the accounting practices, I'll just give a quick overview of each of the companies, and then I just highlighted these 8 accounts, I guess, to go over the differences between the 2 companies. So all of the summaries of the practices were taken from both from Abbott's and Baxter's SEC filing for their 10K annual filing. Abbott is audited by the Deloitte firm. Their statements include the parent company and its subsidiaries, with the exclusion of the intercompany transactions. Baxter, I also took from their 10K filing, and they're audited by PricewaterhouseCoopers. And so I'm going to go over revenue recognition, earnings per share, pension and post-employment benefits, cash equivalents, investments, product liability, Baxter calls it product warranty, the same thing, inventories, property and equipment, and R&D costs. So for Abbott, their first four, revenue recognition, Abbott recognizes the revenue when the passage of title and risk and loss is transferred to the customer. Any type of discount is recorded during the period of the related sale. If need be, the management will record a returns reserve for the related revenue. The revenue of the license of the product rights and performance is also recorded within the terms of those sales. When the rights are exercised. Earnings per share, Abbott uses the two-class method, which requires unvested restricted stock and awards that contain non-forfeitable rights of dividends to be treated as non-participating securities and included in computation of earnings per share. With this method, net earnings are allocated between common shares and participating securities. Pension and post-employment benefits are accrued over the service of each employee. Long-term assumptions are made mostly with respect to cost trends, expected rate of return on plan assets, and are managed by Abbott management. Differences between expected long-term return on plan assets and actual returns are amortized over a 5-year period. Actuarial losses and gains are amortized over the remaining service periods of the employees. Cash and cash equivalents investments. Abbott's cash equivalents are time deposits and CDs with original maturities of 3 months or less. Market equity securities are available for sale and listed at fair value with any unrealized gains or losses net of tax. Investment in debt securities are classified as held to maturity and reported at cost, net of any unamortized premium or discount. And on to the product liability. Abbott, beginning in 2009, started to self-insure all of their product liabilities. So they set up accruals for it when it is probable that a liability has incurred and the amount can reasonably be estimated given the existing information. Prior to 2009, Abbott used a third-party insurer. Abbott uses first in, first out, the FIFO method. For inventories, this cost includes materials and cost conversions. Property, plant and equipment, depreciation is measured using the straight line basis. They consider their buildings to have an average life of 27 years, and equipment has an average life of 11 years. R&D costs are expensed as incurred internally. Their clinical trials are usually performed with a third-party contractor and is expensed as the work is performed. If there is a contingent milestone for payment, that milestone payment is expensed as the milestone is reached. So moving on to Baxter, their revenue recognition differs a little bit from Baxter because they recognize the revenue in terms of service. So when that arrangement exists, the service has been rendered, that is when they recognize the revenue. For product sales, they recognize it as when the risk of loss is transferred to customers, and it's recognize revenue is delayed until post-delivery obligations such as training or installation is completed. Like Abbott, any type of discount or anything is recorded as a reduction of net sales. Earnings per share, Baxter's net income remains, they use, for both diluted earnings per share, Baxter uses the net income as their numerator and the weighted average of common shares during the outstanding period as the denominator for basic earnings per share. They use the treasury stock method to determine the denominator of the diluted shares. The pension and post-employment benefits differs from Abbott as well. They really follow four actuarial assumptions to provide the post-employment benefits to certain employees. They rely on the interest rates to discount pension and other employment benefit plan liabilities, the long-term rate of return on pension plan assets, rate increases in employee compensation, and anticipated future health care costs. Cash and equivalent is similar to Abbott because they have cash, CDs, and money market fund with original maturity of 3 months or less. And the product warranty from Baxter differs from Abbott because they, when the revenue is recognized, Baxter will provide an estimated cost for the related product warranty at that time. These warranties are based upon experience with similar products. The product warranty liabilities are adjusted based upon changes in estimates. Inventories is similar to Abbott. They use lower costs or the FIFO method. Market value for their raw materials is based on replacement costs, while market value for work in process and finished good is valued at the net realizable costs. Property, plant, and equipment is, again, the straight line method over the useful life of the related asset. Buildings and improvements are 20 to 50 years, and 3 to 15 years for machine and equipment. Certain computer software and software developments are capitalized in machinery and equipment over the estimated useful life of the software. R&D is different from Abbott. They have kind of coined this acquired in-process research and development as an indefinite lived intangible asset at the time of acquisition. They also do R&D costs expensed as incurred, and the estimates are given to in-process research and development determined by a discounted cash flow analysis. And that's it for R&D.
Okay. So now it's time for the financial analysis. We chose to look at 2007 through 2010, basically because anything from Baxter that's earlier is really condensed, and we wanted to be able to increase the comparability of the financials. These are lists of the financials that we looked at. And we all know what most of this means, so I'm going to try not to get into too many of the boring details. Liquidity is the time that is expected to pass until an asset can be changed to cash or a liability can be paid. Both companies have high current ratios and quick ratios, but we've shown that Abbott's are generally lower, and they're also a little more volatile. This is due to changes in liabilities, while Baxter's liabilities have been decreasing. Profitability is used to assess a business's ability to generate earnings as compared to expenses or other costs, and the return on assets measures efficiency, while the return on equity measures return on money investors have put into the company. We chose to look at the return ratios specifically because of their relationship to the balance sheet. Both companies show similar growth, but Abbott's is more extreme. The short-term operating activity tells us economic effects of short-term operating over time. The inventory turnover tells us revenue in relation to inventory, and the working capital turnover compares cash to the revenue created by that cash. We chose to change over from the bar graphs just to show you the extremes. Baxter has higher, more consistent, and more desirable ratios, and this is due in part to the higher revenues caused by restructuring their financial governance under the new healthcare laws. Our next ratio tells us a company's solvency, and the debt-to-equity ratio measures after-tax income as compared to total debt obligations. 20% is usually considered financially healthy. As you can see, Baxter has outpaced Abbott and by more than 20% on a consistent basis. So Abbott's been doing pretty good, staying at or above 20%, but Baxter's really been ahead of them on that. This is due partially to Abbott's increasing post-employment obligations, which increased significantly in 2010, and Emily discussed a little about them earlier. Our cash flows provide information to investors, creditors, and others during a specific period. All companies have to control their cash flows in order to continue operations. So this shows the net cash flows for both companies. Abbott has low cash flows as a result of increased investing and financing, but they have very consistent operations. Baxter's cash flow mainly increased in just operations. Despite Abbott's big jump into negative space, their investing activities and the magnitude of their cash flows make them a better buy. But that would pretty much be only in the case of cash flows being the only thing we were considering. A horizontal analysis is used to compare the same items in previous year's statement to a baseline year. So we use the common size analysis to easily compare periods. I indicated a few interesting changes in red, and as I said before, Abbott has done a lot of investing, which was bad for its cash flows. We can see a lot of that was in intangible assets. Baxter's been stable, but its total equity has been kind of shaky. The vertical analysis is used to compare total assets, liabilities, and equity. So again, I highlighted the interesting changes in red. Abbott's inconsistent over time in their acquisitions of goodwill and intangible assets. It kind of comes in spurts. Baxter appears to be gaining long-term debt while paying off its current debt, and the retained earnings have shown a dramatic increase while they've been selling their treasury stock. Okay, lastly, we're going to look at market strength. We looked at market capitalization and enterprise value. The market capitalization tells us what the value of a company is at any given moment. So basically, what it'd be worth if you were just considering its common stock and stock prices. But the enterprise value tells you basically the buyout price of a company and reflects what the market says the company is worth. Abbott's stronger in both market capitalization and enterprise value. And finally, based on the financial analysis, it appears Baxter would be the best bet if we were only going off of these financials.
Alright. We'll go over the outside sources for Abbott. So, we'll just start off with growth over the past 10 years. The average of profits and dividends is between 8 and 9%, and they've had a 25% return on equity, which I think the vast majority of investors would be pretty satisfied with. They're even better for the next 5 years, which, factoring in forecasts and future projections, make one of the fastest growing U.S. pharmaceutical companies, which I'll expand on a little bit. So we identified 3 primary components of the future growth, which would be revenue increases, acquisition program, and a strong R&D program. So the revenue increases, we identified 3 new drugs that are, I guess, increasing the revenue numbers significantly. So the first one would be Humira, which is an anti-inflammatory drug whose sales are growing in excess of 20% a year currently. And then Tricor, which is a powerful triglyceride lowering agent. And then the last one, which I'm not positive how to pronounce, I think it's Science 5 or B, which is a drug which has similar drugs out there in the market, but it has some differentiating characteristics which has made them to project it to grow a lot faster than its competitors. So the second part was the aggressive acquisition program, and they have acquired 3 new companies that I'll highlight, which have significantly helped them out. So the first one would be Pyramel Healthcare Solutions, which is a leading producer of generic drugs in the international market. They also acquired Advanced Medical Optics, which is in the eye care market, and Solvay, which has a strong presence in Europe and international markets. So I think it's safe to say overall, with their acquisitions, there's definitely international flavor to them. So they're trying to expand, obviously outside the United States. Third point is the committed R&D program. Obviously, pharmaceutical companies and healthcare companies aren't going to get the blockbuster drugs that the previous group was talking about without committing a lot to R&D, and Abbott has definitely done that. So, as you can see, there are several that they've highlighted, or we've highlighted, for a treatment for Crohn's disease and psoriasis, and they also have some for oncology, neuroscience, pain management, and infectious diseases. So I think it's important to note that when you're going for blockbuster drugs, like is often what's happening in the pharmaceutical and healthcare industry, that you have several things in the works, because nobody's expecting all of them to pan out. But if you can just get 1 out of 10, or somewhere around there, obviously they make a lot of money on that one drug. So the fact that they have several in the works and they feel strongly about all of them is definitely good for the future. Some negative things, identified 3 of them here as well. So obviously there's a lot of pricing pressure globally for healthcare. Healthcare costs are pretty out of control, especially in the United States, and obviously we just came out with public health care, which is still being debated, but it'll be really important to get prices down if that's going to be a sustainable solution here as well as abroad. So that's something that definitely needs to be considered for all pharmaceutical companies, and Abbott specifically. The second point is the generic competition. A lot of the drugs, as you know, are on patents, which generally range from 15 to 20 years. So when they come off those patents, it's really cutthroat competition to gain the market share for those drugs, and mostly it's done by decreasing prices and being a low-cost leader. So, that can hurt profitability. And then third, the regulatory setbacks, which would cover everything from government regulations to anything about the patents. Obviously, if the patents were decreased, it would be harder for these pharmaceutical companies, Abbott specifically, to break even on the R&D costs they incur if they were to only own that drug for a lesser period of time. So that would definitely affect Abbott negatively if anything along those lines were to change. We have a statistical summary, which I'll just focus on a few points. So it has Abbott and an industry average. So the dividend growth, or the stock yield, is 3.8%, which is slightly above average of 3.2 in the industry, as well as the dividend growth rate of 9% compared to 6%. As you can see, over half the companies don't pay dividends in this industry, so that's something to keep in mind as well. And then for the little chart below, it's again Abbott versus industry averages. So the debt equity ratio is a little bit higher than the industry average, which the graph's a little bit off. So I&D, it's 39 against 15. So then for return on equity, it's 28% for Abbott against 16% for the industry average. So performing pretty well there. Then we have this chart, which is a little bit confusing, so I'll use this handy pointer. This blue line is the balance volume, and then the black line is all the stock prices, obviously. So let's see your prices over here. So what I would note is you can see in 2008, late 2008, and obviously going into 2009, and even recently, as you know, a lot of stocks took a huge hit. So they've still been recovering from that. And right here we have, there's these lines. So the red line shows the downtrend from 2008. And then these lines are the future indicators. So we have long-term uptrend is the blue line, which is right here. The midterm is the brown line, and the intermediate is this purple one right here. So, as I said, there are a lot of lines that can look a little bit confusing, but the one thing I would take away from this is the short-term, the intermediate, and the long-term trends are all going up, which is obviously what you would want to see if you were looking to invest in a company or look at their stock trends. So, now I'll pass it on to Tony for Baxter.
Thank you, Matt. All right. Well, this right here actually shows the fourth quarter results, but I'm going to backtrack and talk about Baxter's third quarter results in 2011, which dates back to October 20th. Pretty much for Baxter, they use a non-GAAP financial measure so that they can help investors see like overall business performance. And like the third quarter sales growth was in 3% domestically. Worldwide sales totaled $3.5 billion in the third quarter and advanced to 8%. Sales in the third quarter for Baxter were driven by balanced growth in the U.S. and internationally. Sales in other categories such as vaccines totaled to $70 million, which saw a 43% increase versus that prior year, excluding foreign currency. Sales for the medical products totaled $2 billion, a 7% increase, but after adjusting foreign currency, it only came out to 1%. And then cash flow from operations in the third quarter totaled $922 million compared to the $1 billion in last year. This reduction was in pretty much like a result to the prior year, which resulted in $111 million. Okay, now moving on to the fourth quarter. Baxter pretty much rose from 9.5%, seeing a growth in the medical products company, and they also saw growth in the bioscience and other segments from there. Analysts from Thomson Reuters expect $1.05 or a 3% growth and expects full-year earnings to $4.57 a share on pretty much the revenue growth from 4% to 5%. Pretty much on the business end of things, Baxter acquired Baxter Corporation for $380 million. It's a private company that was used to develop pharmaceutical compounds that enhance the efficacy of oral doses and preparations. For Baxter Corp, their annual sales was $150 million in 2010, so they have high expectations for the acquisition. And then Baxter always, and then on another key acquisition, they also talked with Synovus Life Technologies, or Sino, and they're thinking about acquiring them for $325 million, which might expand Baxter's presence in regenerative medicine and biosurgery. Pretty much in the stock market, been working. Baxter saw a profit of $463 million, or 82 cents a share, which is up from the $423 million, or 72 cents a year earlier in 2011. This is actually for 2012. And excluding charges tied into the business optimization and assets impairments, their earnings rose from $1.17 to $1.11, which doesn't make sense, so that's vice versa. It's $1.11 versus $1.17 a share. Whoa. Okay, we're missing a slide. Whoa. Yeah, so I actually had a graph on here, but I guess it's not on here.
Isn't the graph with that?
Oh, there we go. You guys just changed like the format, so I didn't see it. But pretty much in the stock market, I just discussed, Baxter opened up at $52.63. They closed at $53.